WealthSimple wants you to believe they are different. They promise commission-free trading, simple investing, and a platform built for regular Canadians who are tired of getting squeezed by traditional banks. Their marketing is clean, their app is sleek, and their message is clear. We are here to democratize finance. But here is an uncomfortable question nobody wants you to ask. If trading is free, if the fees are so low, and if the barriers have been removed, how exactly is WealthSimple making money? And more importantly, who is really paying? This is The Financial Historian, where money, power, and history collide. Today we are dissecting the business model of Canada's favorite fintech darling. Once you understand how WealthSimple actually generates revenue, you will realize that free is never really free, and the democratization of finance comes with a price you might not have noticed. The first thing to understand about WealthSimple is that it is not one business. It is multiple revenue streams bundled together under one brand. That bundling is intentional because it allows them to offer certain services at a loss while profiting handsomely from others. This is the classic fintech playbook pioneered by companies like Robinhood in the United States. Lose money on the headline feature, make it back everywhere else. Now we will break down exactly where the money comes from. The most visible product is WealthSimple Trade, the commission-free stock trading app. When WealthSimple launched this feature, they made a bold claim: zero commission trades for Canadian and US stocks. No hidden fees, no fine print, just free trading. And technically that is true. If you buy 100 shares of a Canadian company, WealthSimple does not charge you a trading commission. But here is what they do not advertise quite as loudly. Free trades do not mean WealthSimple is not making money from your trades. They absolutely are, just not through commissions. The first revenue source is the foreign exchange spread. When you buy US stocks using Canadian dollars, WealthSimple converts your money, and they do not do it at the market rate. They add a markup, typically around 1.5% on each conversion. That might not sound like much, but think about the mechanics. You convert Canadian dollars to US dollars when you buy, and US dollars back to Canadian dollars when you sell. That is two conversions, two markups. If you are an active trader moving between Canadian and American markets, those spreads add up fast. For WealthSimple, this is a pure profit margin baked into every cross-border transaction. You think you are trading for free, but you are paying a hidden tax every time you cross the currency line. And here is where it gets more interesting. WealthSimple offers a premium tier called Trade Plus, priced at around $15 per month. One of the main benefits is reduced foreign exchange fees. So the free product charges you hidden spreads, and the paid product reduces those spreads but charges you a subscription. Either way, WealthSimple wins. It is a textbook example of tiered monetization. Offer something for free with friction built in, then sell a premium version that removes the friction. The brilliance is that most users do not even realize the free version has friction until they have been using it for months. But currency spreads and subscriptions are just the surface. Let's talk about something most WealthSimple users have never thought about: payment for order flow, or more accurately in Canada, rebates from market makers. In the United States, this practice became infamous after the GameStop saga exposed how Robinhood was selling customer order data to high-frequency trading firms. Canada regulates this differently, and WealthSimple has publicly stated they do not engage in payment for order flow in the traditional American sense. But they do route orders through market makers, and those market makers profit from the spread between the bid and ask price. WealthSimple benefits indirectly by negotiating execution quality and potentially rebates tied to order volume. The key point is this: when you place a trade, there are invisible players in the middle profiting from the transaction, and WealthSimple's relationship with those players is part of their economic model, even if it is less direct than Robinhood's approach. Now let's shift to the bigger, quieter moneymaker, WealthSimple Invest, their robo-advisory platform. This is where WealthSimple started, and it remains a core part of their revenue. The pitch is simple. You deposit money, answer a few questions about your risk tolerance, and WealthSimple builds you a diversified portfolio of low-cost ETFs. They manage it for you, automatically rebalancing and optimizing for taxes. It sounds perfect for hands-off investors, and it is convenient, but it is not free. WealthSimple charges a management fee on your invested assets. For basic accounts, the fee is 0.5% per year. For premium accounts with access to human advisors, the fee is 0.4% per year. That might sound tiny compared to the 1.5 to 2% fees traditional mutual funds charge, and it is lower. But here is the thing. The ETFs WealthSimple is buying for you already have their own management fees, typically around 0.15 to 0.25%. So your total cost is actually closer to 0.65 to 0.75% annually. And because WealthSimple's fee is based on assets under management, the more money you have with them, the more they make. If you have $100,000 invested, they are pulling in $500 a year just from management fees, plus the embedded costs of the ETFs. Now, is 0.5% expensive? Not compared to traditional banks, but compared to managing your own portfolio with the same ETFs, absolutely. If you bought those ETFs yourself through WealthSimple Trade, you would pay zero management fees to WealthSimple, and only the ETFs internal cost. The robo-advisor is a convenience product, and that convenience costs you 0.5% every single year, compounding over decades. For someone investing over 30 years, that difference can cost tens of thousands of dollars in lost returns. WealthSimple knows this, but they also know most people value simplicity over optimization, and they are betting correctly that the majority will not do the math. Then there is WealthSimple Cash, their spending and savings account. On the surface, it looks like a loss leader. No monthly fees, decent interest rates on savings, and a sleek debit card. So where is the money? The answer is interest income and interchange fees. When you keep money in your WealthSimple Cash account, WealthSimple deposits that money with partner banks who pay them interest. WealthSimple passes some of that interest to you, but they keep a spread. The more cash sitting in their ecosystem, the more they earn on the float. It is the same model banks have used for centuries. Borrow from depositors at low rates, lend or invest at higher rates, and pocket the difference. Additionally, every time you swipe your WealthSimple Cash card, the merchant pays an interchange fee to the payment network, and a portion of that fee flows back to WealthSimple. These fees are tiny per transaction, maybe 1 to 2%, but across millions of transactions, they add up. WealthSimple is not charging you directly, but they are making money from your spending behavior. The more you use their card, the more revenue they generate. It is a classic example of monetizing engagement without charging the user overtly. And let's not forget WealthSimple Tax, their free tax filing software. Why would they offer this for free? Because it is a funnel. When you file your taxes through WealthSimple, you are likely to see prompts encouraging you to invest your refund, open a cash account, or explore their other products. Tax filing is a loss leader designed to acquire customers and cross-sell them into higher margin products. And it works. People trust the brand that helped them file their taxes, and that trust converts into deposits, trades, and managed assets. The free product is not the business. It is the gateway. Now let's zoom out and look at the bigger picture. WealthSimple's revenue model is built on three core principles: tiered monetization, cross-selling, and asset accumulation. They offer free or low-cost entry points to attract users, then monetize through premium features, adjacent services, and management fees. The more products you use, the more revenue streams they unlock. And the longer you stay, the more assets you accumulate with them, the more profitable you become. This is the fintech flywheel. Acquisition is expensive, but retention is gold. But here's the part that should make you pause. WealthSimple's entire business depends on you keeping your money in their ecosystem. The longer your cash sits idle in their account, the more they earn on the float. The more you trade across currencies, the more they collect on spreads. The more assets you manage through their robo-advisor, the more they charge annually. And the more you use their premium features, the more subscriptions they collect. They are not evil for doing this. It's just business. But it does mean their incentives are not always perfectly aligned with yours. For example, is it really in your best interest to keep large amounts of cash sitting in WealthSimple Cash, earning modest interest when you could be investing it for higher returns elsewhere? Probably not. But it is definitely in WealthSimple's interest. Is it optimal for you to trade frequently across borders, racking up currency conversion fees? No. But every time you do, WealthSimple profits. Are you better off paying 0.5% annually for automated portfolio management, or learning to manage a simple ETF portfolio yourself? For most people, doing it yourself would save significant money over time. But WealthSimple's revenue depends on you choosing convenience over cost. This is not unique to WealthSimple. Every financial institution, from the oldest bank to the newest fintech app, has the same fundamental tension. They make money when you use their services, and that profit comes, directly or indirectly, from you. The difference with WealthSimple is the marketing. They position themselves as the anti-bank, the company that is on your side, making finance accessible and transparent. And in many ways, they are more transparent and more accessible than traditional banks. But transparent does not mean free. Accessible does not mean optimal. And democratization does not mean there is not a business model underneath. The uncomfortable truth is that free in fintech is almost always subsidized by something else. Robinhood's free trades were subsidized by selling order flow to high-frequency traders. WealthSimple's free trades are subsidized by currency spreads, premium subscriptions, and asset management fees. The product isn't free. The business model is just less visible. And that's by design, because if users clearly understood every fee, every spread, every hidden cost, they might make different choices. Opacity is not an accident. It is a feature. So what should you take away from this? First, there is no such thing as a free financial service. If you're not paying directly, you're paying indirectly, or you are the product. Second, understand where your provider makes money, because that's where their incentives lie. If WealthSimple profits from currency spreads, expect them to make cross-border trading easy and appealing. If they profit from assets under management, expect them to encourage you to invest more and keep it there longer. Third, convenience has a price. WealthSimple's robo-advisor might be simpler than managing your own portfolio, but that simplicity costs you 0.5% annually. Over decades, that compounds into real money. None of this makes WealthSimple a bad company. In fact, for many Canadians, especially those intimidated by traditional banks or new to investing, WealthSimple is a genuinely good option. Their fees are lower than most mutual funds. Their platform is user-friendly, and their product suite is more accessible than what the big banks offer. But good does not mean optimal, and accessible does not mean you should stop thinking critically about where your money goes and who profits from it. The lesson here is not to avoid WealthSimple. It is to understand the game. Every financial company makes money somehow. The question is whether you are paying a fair price for the value you are receiving, or whether you are subsidizing their growth without realizing it. History teaches us that the most successful financial institutions are the ones that master the art of making you feel like you are winning, while they are the ones collecting the rent. WealthSimple has done that brilliantly. They have built a brand that feels friendly, modern, and aligned with your interests, and in many ways, they are better than the alternatives. But at the end of the day, they are still a business. Businesses exist to make money. So the next time you see commission-free or no fees, ask yourself, where is the money actually coming from? Because once you see the business model, you cannot unsee it. And once you understand how WealthSimple makes money, you will make smarter decisions about whether their convenience is worth the cost. If this gave you a new perspective, hit subscribe. History has the answers. I will show you where to look.